stuck in that same.
You looked at it? Okay. So let's figure out.
I read.
So the accounting period, what's the normal accounting period? Time? Could be about the fiscal year or calendar year, right?
Yeah.
So it could be a period of 12 months, right?
Thank you so much. I'll let you know what's going on.
And the way that this is broken down, you may have financial statements that may be broken down quarterly or even monthly or semi-annually, which means twice a year, or annually once a year, right? Well, we use this to figure out how often we need to adjust for our transactions. So accrual basis versus cash basis. This is very important. Most of the time, most businesses work on accrual basis. So what does that mean? We recognize money, recognize earned money as it happens, right? Regardless of when we receive the actual cash. And then we recognize expenses as they are incurred versus cash basis. We don't recognize revenue until we actually receive the cash for it, and we don't recognize expenses until we actually pay for those expenses. Everybody clear about that? Sure? Okay. You said no?
No, I'm not.
Oh, okay.
I got a question.
Yes, sir.
On the accrual basis,
Mm-hmm.
there was something on this chapter homework with that, and just plugging that in.
Mm-hmm.
When the revenues are recognized, it's not cash coming in.
Right.
Right?
Unless it says
Unless it says cash.
that they
However,
receive cash.
when you plug that in, that's plugged in that's plugged in as a debit?
Okay, so let's look at it this way. If you perform services for cash, what two accounts are affected?
So cash is gonna be affected,
Mhm.
and revenue.
Revenue. So you're acknowledging that you just did some services, right? You completed some service. Regardless of whether you receive cash or not, you know for a fact you earn revenue, right? So what is the normal side of revenue accounts? Credit. Credit. So that means anytime your revenues increase, you're going to place that amount on what side?
Credit side?
Credit side. And anytime they decrease, which they never will, by the way, it will go on the opposite side.
So they never
Revenues will never decrease.
Okay, so if you don't receive cash,
It didn't change the fact that you earn revenue, though.
Okay.
So this is what we mean. And let me just, because I think the word recognize is thrown out there and people don't really know what it means. Recognize means I concur, I acknowledge that this has happened. It doesn't matter what has been exchanged in the hand if we're talking about accrual. But I acknowledge that I have earned revenue. I acknowledge that I have a utility expense to pay. I acknowledge that I have supplies to replace. That's what recognize means, okay? Realized, which is a word you have not really seen yet, realize means to attach a monetary amount to it. So recognize means to acknowledge. Realize means to what?
Attach. Okay.
And we might as well say measure. Okay, that's the best way to look at it. Measure in monetary terms. So I can say I acknowledge that I earned revenues because I performed services for a client. I realize that that amount is $5,000. Everybody get it? Okay. Monetary amount to it, or measuring it in monetary terms.
And it just means I have to show that I have my acknowledgement is to credit this revenue account to show that the reason that I
earned it.
Okay.
You earned it.
Okay. What is I have a problem like land and building.
Mm-hmm. What are they?
Would they fall up under?
What are they?
What I said?
Assets. So where do they fall? Now, look at this. Accrual basis is strictly followed by those corporations that are governed by GAAP. What's GAAP? Everybody should know it. Generally what?
Accepted accounting
Principles.
principles.
Right. So generally accepted accounting principles follows the accrual basis. It's not saying that a company can't use the cash basis, but a company that uses cash basis, that means that they clearly don't follow what principles?
Yeah.
Yeah. So accrual basis versus cash basis. Let's look at this example. It says on December 1st, 2015, fast forward, paid $2,400 cash for a 24-month business insurance policy. So automatically reading that, they paid $2,400 for an insurance policy for 24 months. What accounts are affected here?
Prepaid insurance.
Prepaid insurance and what else?
Cash.
Cash. So it says using a cash basis, that entire $2,400 would be recognized as insurance expense. Do you see the difference? If it was accrual, we would have just done what?
Prepaid.
Prepaid insurance and cash, right? And that's basically saying I am what? What's the R word? Recognizing that we paid realized value of $2,400 towards insurance that has not been used yet. 24 months worth, right? If we were doing accrual basis, we would not take it out of prepaid and put it into insurance until what? As the months expire, right? But notice under cash basis, they are literally expensing that entire $2,400 right then and there, regardless of whether or not the months have passed by. They're not even recognizing it as prepaid insurance. What are they saying? Put all of it where?
Insurance.
An insurance expense, and of course, credit cash. Now, what does it say down there in the orange writing? No insurance expense from this policy would be recognized in 2016 or 2017 periods covered by the policy. So it's just saying we're paying up front, we're expensing it up front. We don't even need to recognize it anymore after 2015. You understand? Now look at this. On the accrual basis, $100 of insurance expenses recognized in 2015, $1,200 in 2016, and $1,100 in 2017. Why? Because we put it all in prepaid, and every time a month passed by, what do? We took whatever the month was for, right? $2,400 divided by 24 months means $100 a month, right? So apparently when we purchased this policy, the only month that had passed by clearly was December. So we had to recognize that in that year. And then we go into 2016 and it's $1,200 for that full year, right? $100 times 12 months. Then we go into 2017 and we recognize $1,100 because that was all that was left from the $2,400 policy.
So are there particular businesses then that use the cash base as opposed to accrual because of the way they need to?
Yes. So conceptualize it. What business do you honestly think would benefit more from a cash basis accounting method versus accrual?
Type of business?
Yeah, just think about it.
Any small
Restaurant.
It's not about small business, restaurants. Yes, because what?
they could be on this.
They make sales right in and there.
Right then and there, and they also pay tips to waiters and waitresses, right? Amongst other things. And because it operates every day, they are purchasing, things are going in and out
Every day.
every single day. What other business can you think would benefit more from a cash basis versus accrual?
A barbershop.
Barbershop, salon,
Yeah.
what else?
A car,
No, that's how you tell it.
No, not necessarily car dealership because they deal with loans and things like that. grocery stores,
So a lot of places like a high school.
retail, you know, those are places that cash is exchanged so frequently, right? And as soon as cash is coming in and sometimes going right back out, cash basis would only work for them because they're recognizing things as soon as they happen. Versus if you're an attorney, you would be on accrual basis. Because more than likely, whatever you, the cash outflows, and the inflows are not every single day. That's fluctuating between 30, 60, 90 days. So you have no need to really expense out, you know, cash right away. It's not a big deal because guess how often you do your books? If you were an attorney or a CPA, how often are you doing your books for your business? Once a year, annually, right? So it's really no need for you to do cash basis, right? Okay, so we've established the difference between the cash basis, accrual basis, recognizing revenues. We already know revenue recognition principle says we recognize revenue as soon as it is earned, right? We've been using service as an example, but if we were dealing with like a product, as soon as the product is shipped and delivered to the customer, you know, that's fine, but we recognize it the moment that we do what?
Receive it.
The moment we ship it.
Okay, I got a question about that.
Yes, ma'am.
Justin using that example.
Uh-huh.
So if I'm a company
Mm-hmm.
and I produce watches
Yes.
and a retailer
Mhm.
sends me a purchase order,
Uh-huh.
that purchase order has not been paid for yet,
Correct.
correct?
Mm-hmm.
Do I count that revenue when I receive that purchase order or do I
Yep.
count that? Okay.
If you are doing accrual basis, you do. If you are the type of person that says, I will not recognize my revenue until I actually get the cash for it, then at that point, what method are you using?
Cash flow.
Cash basis. But if you are saying, I'm recognizing this revenue as soon as I receive this purchase order because I'm going to fill it and I know I'm not going to get payment for it right now, but I'm going to go ahead and ship it to the customer, that will be accrual.
So you think cash is better, cash back is better than
No, I wouldn't say that. It just depends on the type of
the situation?
business that you have.
Okay, I'm a little confused.
Okay?
The difference between the two, the accrual basis and cash,
Mm-hmm.
is when you're saying cash is when they actually receive it right then.
Yes.
Okay, and then the accrual is when, like.
You don't receive it right then, you just recognize it when it happens.
Okay, for example.
The money, but you haven't sent it out.
No,
It's like
No.
it's like credit, like, not like credit.
you
like
guys are
credit.
overthinking it.
Okay.
Accrual is when I do something for you, but you didn't give me any cash for it, but we've acknowledged that I've done it and you owe me.
Okay, like you
Like
painted
favor.
my house.
You are overthinking it.
Okay, alright.
I perform services for you.
What kind of
You
service?
did, it doesn't matter, you are overthinking.
Okay.
I provided services for you.
Mm-hmm.
You have established that I did this for you and that you owe me money. I'm gonna recognize that now because I did it now, regardless of when you paid me.
Where would I put that?
That's revenue and accounts.
What we've been talking about all this time.
Okay, alright.
Earning revenue,
Okay.
earning revenue. That's
So I'm
what we're
gonna put
discussing
that
right
there.
now.
Yeah, under revenue and accounts receivable.
I, as providing a service for you, will record that in my revenue and accounts receivable because you're gonna pay me eventually within 30 to 90 days, right? Versus I am, perfect example. I fixed her automobile.
Okay.
When do I get paid? Everybody in here got a car. Like that.
When you finish.
Have you ever been able to pay a mechanic 30 days later?
No.
I wish it was one out there that allowed me.
Yeah.
You're very hard about it.
Immediately. They are on a cash basis
Okay.
accounting. And you know why? Because the same money that they earn from you for fixing their car, they're going to take that money and go do what with it?
Well, they-
Pay the people, buy more parts to fix somebody else's car, continue to operate. Right? Yes, ma'am.
So if I'm operating a restaurant on a cash basis,
Mm-hmm.
where then do I put if I have like a account receivable?
If you're a restaurant, you wouldn't have any accounts receivable. That's what I'm trying to get you to see.
So here's my question. Right, that was my question, as far as catering goes, because if you're operating in a cash basis and you take on a deposit, that deposit would get acknowledged immediately, and then you would just wait and add.
The rest of it.
Okay.
That's the iffy part. Now, I mean, typically,
You wouldn't have nothing like that.
the odds of you just running a restaurant that only does catering these days is slim to none. But yes, in that instance, they pay a half of it
Yeah, if you're the
or deposit. Yeah, you got to put the remainder on accounts receivable. And it doesn't change the fact that you operate on a cash basis. Because what did you do? Even though you catered it and they're not paying you the rest until later, you still did what? Right then. You still collected cash.
Right.
Yes, sir.
You know, when we have any problems with that, like that, stuff like that.
No. Not, catering, half and half, no.
Okay.
Not even booking. That was just kind of like a real life scenario that she
Do the
gave.
ledgers change any?
Ledgers.
Like the way that we do, like the account names, the ledgers, or the way that we do the money, does it change?
Believe it or not, just because it's a different method of accounting, your chart of everybody's chart of accounts for a business, thank you, are going to be different, but they're not going to fluctuate that much.
Okay.
Just because you're on cash basis doesn't mean you wouldn't have an accounts receivable ledger or a cash ledger or any of that other stuff. All that stuff stays the same.
Okay.
It's just your method in the way that you recognize and realize those things. Same thing with expenses. If you recognize, if you are under the accrual basis, if you recognize revenue in 2015, you're going to also have to recognize the expenses that went along with that revenue in 2015. Those are things that you've already, been accustomed to. So, framework, so adjustment. You only make adjustments in certain areas. It's not everywhere, but it's in certain areas. So, paid or received cash before the expense or revenue was recognized, you would have to adjust for that later. I'll explain it. Paid or received cash after the expense or revenue recognized. Prepaid deferred expenses, like these prepaid insurance and prepaid rent and things like that. The adjustment would be what? What are you adjusting for with prepaid insurance or prepaid rent?
$100 a month that
As
the month.
it expires, right? That's the word that we use in accounting, expired. So it's prepaid or deferred until it expires. And once it expires, we take it out of prepaid and we put it in that expense account, whatever the expense is. Unearned deferred revenues. I think I explained unearned revenues before.
The ticket sale.
The concert ticket. Do you guys remember that? You buy concert tickets. Do you buy them the day of the concert or you buy them ahead of time? Ahead of time. So that performer recognizes their revenue as unearned until they do what? Perform the concerts. And as the concerts are performed, we take it out of unearned revenue. We put it in where? Revenue. Because it's earned at that point. Now, accrued expenses, paid or received cash after the expense. And I'm going to give you some examples of that in a few. Same thing with revenues.
Yeah, I understand the part. I just don't understand.
We'll get to it. This is what I've been talking about, right? Resources paid prior to receiving the actual benefits. So if it is an asset, once we debit that asset, that's unadjusted. And the reason it's unadjusted is because it's prepaid. So eventually you got to take it out of prepaid and put it in whatever the expense is, right? You decrease it once you recognize the expense. Debit that expense account, credit the asset. I'm going to give you real examples to make it more simple. Here's some things. You got prepaid insurance. Determine what the current account balance equals. then determine the current account balance, what it should equal, record the adjusting entry, right? So let's start with prepaid insurance. That prepaid insurance account has $5,000 debit balance to start the year. A review of insurance policies and payments shows that $1,000 of unexpired insurance remains at year end. So that means we use how much money had expired for that prepaid insurance? How much? 4,000, because it's still 1,000 left, right? So if we had to determine what the current account equals, we know the current account is 1,000 because it said that, right?
Right.
Determine what the current balance should equal. Still 1,000. Record the adjusting entry. So what do you think the adjusting entry is for that one? And I want you to write it down on your paper. But just think about it. Prepaid rent. On October 1st of the current year, the company prepaid $12,000 for 1 year of rent. The company debited prepaid rent, which they should have, for $12,000, and credited cash for $12,000. It says December 31st year-end statements must be prepared. So by December 31st, it's no longer considered prepaid rent, right? Because that would have been 12 months. All right. Supplies. Supplies account has $1,000 debit balance to start with. Supplies of $2,000 was purchased, so you take that $2,000 and do what with? You purchased it, right? So what do we do with it? Add it to what it started with. Didn't it start with 1,000? You purchased supplies of 2,000. You need to add that 2,000 to 1,000. So now you have how much supplies? 3,000. And it says that December 31st physical count shows how much remaining? 500. So we used how much? $2,500 worth of supplies. Think about that when we do the adjusting entry. Accumulated depreciation, and I will teach you about depreciation. However, it says the company only has one fixed asset, equipment, that it purchased at the start of the year. It cost $38,000. Has a 10-year useful life, and is expected to be valued at $8,000 at the end of a 10-year life. So we have to adjust for the depreciation that has passed. Now look at this, prepaid insurance. It had 5,000. We ended up with 1,000, right? So you told me how much had expired? 4,000. So this is what it looks like before we adjust for what has been used. This is the unadjusted balance in the ledger of 5,000 for prepaid insurance. Now we've determined that this is all that is left is 1,000. We had to adjust for it, but you don't see the adjustment yet. You got to make the journal entry to adjust it. So this is the journal entry that you make. A debit to insurance expense because you're increasing it for 4,000. And you're taking it out of prepaid insurance for 4,000. So now that we know for sure our balance is 1,000. Questions? If you got questions, hurry up and raise your hand. We have to move through these things. So I want to answer your questions and get through it. Yes, sir.
Can you repeat what you just said about the 4,000?
How much insurance did you start with?
5,000.
5,000. And it's prepaid, by the way. So it means that it hasn't occurred yet. It hasn't been used yet. They told you how much was left on hand at the end of the year.
Oh, wow.
$1,000.
1,000, right? So that means you had to have used how much?
4,000.
4,000 of it. So prepaid insurance is an asset account. In order for you to adjust it, you have to credit for that 4,000 that was used to leave a balance of how much? 1,000. That's how you do an adjustment.
Okay, so we don't have to worry about logging in that.
Say it again.
I'm sorry. When we do the general ledger, we don't have to worry about logging in that $1,000.
No, we're just gonna account for it, right?
No, you do gotta get to the $1,000.
You can't do like 5, like,
Yeah, you're doing that, but you're doing it where?
oh,
In the T account.
Your ledger, because I think you guys still don't know the difference between the ledger and the journal. Okay. which you need to, by the way. But you're doing a journal entry to adjust the ledger account. So we are acknowledging that we are taking $4,000 out of prepaid insurance, putting it in insurance expense. We are going to our ledger, which this is what this is. We're crediting for that $4,000 to make sure that our running balance left is $1,000. Yes, ma'am.
Okay, so what she was asking is, would that $1,000 that we just made that adjustment from the ledger go in the general journal? But it wouldn't, right?
No,
Is that-
general. She said general ledger, but yeah, general journal.
I'm sorry,
No.
general journal. Oh,
No, yeah.
General ledger. Yes.
Right.
Journal. No. The only thing you put in the journal is the actual amount that you are adjusting, which is the $4,000 here. Now, going to this next one, prepaid rent. How much rent did they pay up? $12,000
$12,000 for 1 year.
for 1 year. So that means rent was around how much per month?
$1,000.
$1,000. Now, the balance of the account started off with $12,000, right? And then what happened? We're at the end of the year now. So now we have to adjust. So it should be how much? Why 9,000?
Okay, starting in October.
Started October 1st. So we had how many months left in the year? October, November, and December. That's $3,000. So that's what we're adjusting for. You have a confused look.
Yeah, but I get it now.
We paid for the rent, that prepaid rent of $12,000 we paid on October 1st. We can't recognize a full year worth of rent because we didn't pay it for that full year. We paid it for
Those 3 months.
just only those 3 months have passed.
Okay.
So 3 months worth of rent, $1,000 a month. So we need to adjust for those 3 months that are going to pass, right? Which means that ultimately the balance of the prepaid rent account should be left at $9,000. How do we adjust? We debit rent expense for $3,000 that has been used, and we credit prepaid rent to take it out of that for $3,000. It's really these adjusting entries. It's the same process. It's just different accounts being used based upon what the scenario is.
So,
Yeah. Somebody had a question.
so that you have to write this every time we do that, write the journal out.
That's the purpose of adjusting. So yes, for everything that must be adjusted, you have to do an adjusting journal entry. Okay, because otherwise the account balance won't be correct. Last one. Supplies account. What did you start off with in supplies? What did you purchase along the way?
$2,000.
So that means that the balance should have been, how much did they say was remaining? 500. So we have established that it should be 3,000. That's unadjusted, right? Then it should equal 500. What has happened? We need to do an adjusting journal entry for what has been used. So we debit supplies expense for 2,500. We credit supplies. Now that's a different one. Credit supplies, right, for 2,500. Any questions about this? Yes, ma'am.
Did I print this out?
All these PowerPoints are in the course.
Okay.
I ain't gonna get on y'all again about
No,
going
I
through
know,
stuff
I
in the
know,
course, but
I'm just saying, cause each one of those things popping up, so I didn't know if it was something different.
it's all the same PowerPoint. I just used the same one that's in the class. Now, depreciation. This is probably a word that you've heard, but you just didn't know what it was. At this point, every asset that you purchase, not every asset, but most assets that you purchase have a value that will be declining as the asset is being used. The example that I can give you is your car. It depreciates the moment you take it off the lot. Meaning, it doesn't mean that it's losing value. It means that once you start using it, that use is being subtracted away from the overall value of the asset. So this asset cost us $38,000, so that's what we're going to recognize it as, right? It has a 10-year life. Now the thing is, we have to determine how much depreciation do we recognize a year. Well, if it's 10 years worth, 38,000 divided by 10 is what? 3,800 a year that this asset depreciates for 10 years. 3,800. So they're saying that it's expected by the end of 10 years to be worth how much? 8,000. So the balance right now is 0 because depreciation would not have a balance to start with, not accumulated depreciation. Now the current balance should equal what? Because this is that formula that I told you about. Anytime they give you a value that they say that's what it's supposed to be worth, that is called salvage. It means once you get to that 10-year, it's only worth that amount, and that's probably the most that you can sell it for. Okay? So it said that it probably will be worth 8,000, which means you can't sell it for 9. Because it's only worth what? 8. Now you can sell it for less if you want, but you can't sell it for more than 8. That's what we're getting into. Depreciation expense. Okay, so you know how I just told you 38,000 divided by 10 years? Write these things down. The 38,000 is cost. No. 38,000 is cost. So this, oh, come on now. No. Hold on.
Oh. So is it 3,000?
So this is the cost of asset. That's what this is. This is salvage value. Yep. This is what we call useful amount of years. So typically, when you're dealing with depreciation, you got 3 things you need to be concerned with. Cost, if there is any salvage value, and the useful amount of years. What are useful amount of years? You buy a car and they tell you that it will at least last you 10 years. That's what useful amount of years means. Salvage value means at the end of the 10 years, it may be worth this. If you want to sell it, this is what you could sell it for. Okay, that's the most that you can get from it. Now, we do this formula every time we're trying to determine what depreciation is. So once you do this, this is how we got to the $3,000. Cost minus salvage divided by useful years. Cost minus salvage divided by useful years. Cost minus salvage divided by useful years equals depreciation expense.
So is that's the formula pretty much that's used like in a blue book, when you get a blue book value on a vehicle, something like that? That's what they're doing?
Yeah, that's what I was thinking. Blue book, it will give you a salvage value. They won't give you a depreciation expense.
So my question is that, I mean, and I can understand exactly how this works in like for a vehicle.
Right.
How does the company do this for like a printer press or a stove or do you have
It depends on whatever the useful life the company tax on it.
Okay.
So, for instance, that now everything does not depreciate, by the way.
But all
Okay.
equipment does though,
All equipment,
and all land, right?
land does not depreciate.
It can increase before it.
Value, it can hold. It does not depreciate.
It never
Okay.
It does not depreciate.
Right. It can be
Land
up
holds value, so it's either gonna go up in value or down,
Gotcha.
but it does not depreciate. Depreciation is taxed to things that are tangible, touchable, usable.
Like iPhones.
Yes,
Okay.
tangible, not intangible things. Intangible assets like patents, trademarks, copyrights, those do not depreciate. Tangible things that you can touch, printers, copiers, computers, desks,
So
those things depreciate.
So in a business with those things, do they always have to do this? In a
Yes, it helps them. It's an expense for them, a write-off for them.
Well, you don't need to be paid.
It's tangible, you can touch it, but can you move it?
No.
You can't depreciate it.
I mean, you can't.
I'm confused.
Okay,
Like I said,
okay.
I'm looking at it like
Y'all overthinking it.
my home.
If I can, your home is not
I'm saying,
depreciable. It can go up and down in value. I do not want you to confuse value with usefulness, okay?
even though when I say, you don't take care of it.
Will your home stop being a home for you in 30 years?
If it's
No.
damaged,
No. So how can you depreciate it?
if it's damaged, though,
But that's damages.
Can you still live in it?
Yeah.
if it's damaged, you can.
Can you still walk in it?
Mm-hmm.
Does it disintegrate to ashes where it just cannot be walked into anymore? Can it be rebuilt?
Yes.
It's not depreciable. Even with a car, you can put a new engine in it, you can put a new transmission in it, but guess what? If it still wants to die on you, it will. Do you guys, you really not, it's not clicking. I don't know why.
I got it.
Your home will still be useful to you after
Unless it
10
burn
years, regardless of if the value is up or down, right?
Mhm.
Your car, however, it may say 10 years and you might get an extra 3 out of it, but when it wants to die on you,
You're gonna die.
it is done. Your computer, when your motherboard decides to say, I'm finished, it is of no more use to you. What do they tell you when your motherboard goes out? Get an entirely new system.
Like a transmission.
Now, when your house has a flood or burns or something falls on the roof, you can't go to the mortgage company and say,
I need a new house.
I need a new house. It just does not work that way, right? Now, we know in theory, yes. What do? They give you money to do what to it? Rebuild it or fix on it or fix the problem with it, right? When your car goes out, does the leasing company say,
No. No.
let me give you a new roof to put on the car?
Nah.
No.
I thought that's like when you get like a break in your car.
That's a shame.
That's different. Do not confuse usefulness with valuation. There are things and assets that you own that will only go up and down in value, right? But you cannot depreciate them because depreciation depends on usefulness. Your home is still usable even if your roof has caved in, because you can still walk through the front door, hopefully. It's still on whatever ground it was built on. It's a matter of somebody coming and rebuilding what? The structure of it. But it doesn't change the fact that it still holds value. That's different with this particular piece of equipment. Even after 10 years, the salvage value is $8,000 at the end of the 10-year life. What do you think it'll be in 5 more years? Useless. It's a difference between usefulness and the value of something. We sure? If somebody wants to depreciate their building, you can't do that.
And it determines the value, the usefulness, how long it's been used does determine.
Not how long it's been used, how long it can
The
be
remainder of
of
time.
use.
So that 8,000 on the salvage would be saying that we determine that there's that much value
Usefulness left, and that's an estimate. That's not even a guarantee. It's just like your car. They say 10 years, but what if it goes to put on you in 7 years because you did a lot of wear and tear and driving around the country in it and fixing things on it and putting things on it that shouldn't have been there or didn't come with the car. you've lowered the value and you've also made depreciation that much higher. Because you have the ability to change what's going on with it. A copier, depending on how you treat it, is gonna be useful for the amount of years they estimated it for, or it might even be less useful because you roughhoused it. Yes, ma'am.
Is this, not ledger, yes, ledger. Is this ledger accounted for monthly, is it accounted for?
Depreciation is accounted for, depending on the business again, but in this particular situation, this is an annual thing that we do depreciation for. We depreciate annually. Even though we know it happens monthly, we only put it on the books at the very end of the accounting period. Mr. Banks?
No, I was just saying that my sister does taxes. I know she does that. People have business and she does a depreciation thing where the stuff that they have in the company.
Equipment and assets, right? Please tell me she's not depreciating buildings.
Well, I don't think she.
I hope not, because that would be a horrible thing.
A company called Dow, and we used to move houses. We literally would beam under houses, pick those houses up and move them.
Did it make them any less useful?
The building itself? No, the building is still useful.
Right.
But it's.
Can't depreciate it.
Okay, so no matter the land where it's sat doesn't, if the land value, I guess what my head is trying to wrap around is more valuable or less valuable than another piece of land that the house sat on, then it increases the value of the
Now
house.
we're moving into real estate.
Oh,
I'm teaching you accounting.
Okay.
Just a quick question, so you said it's recorded yearly, so does the number 3,000 change or?
That's what it is for this year. This is the depreciation expense for this year in question. Next year is gonna be something different.
Because the salary will change, right?
Nope.
Why would it be changed?
3,000 is going to be 3,000 up until what year? 10th year. And then after that, what do you think happens? There is no more. There is no more to depreciate.
Okay, so depreciation will hit a max, and then that's just what.
The max is the useful year. So if it's useful for 15 years, I'm gonna probably either hit my max depreciation before 15 or right at 15. Let me show you how this works. This is 3,000, right?
Right.
So that means this asset went from 38,000 in the first year to what? 35,000. Next year, what did it do? 32. Next year, what did it do?
Because you keep depreciating every, whatever.
For 10 years.
What are we down to now?
29.
And it does this until what?
Max.
Till we get to the max or till we get to
Zero. Can you?
salvage. Salvage. Salvage is saying not only can this is the max amount that you can sell it for, but after you get to this amount, you can't depreciate this asset anymore. We will no longer allow you to expense your depreciation up until that point.
So if you're still using it at that point in the company, then you're just still using it.
You're just using it and it's still working. Yeah. And that may just be what, you choose to do. And that's fine. Companies do it. They don't just discard an asset just because it's reached the max.
And now
Yeah.
let me ask you this, if it reaches the next 10 years and they still use it for, let's say, like another 2 years after that, are they still reporting value for this? Or is
It still has value, but what can't they do anymore? Depreciate it.
so it will still hold that 8,000 value, or is just whatever?
No,
value
the value's
company
gonna
placed on
continue
it?
to go down, because it's gonna be based on market, whatever the market says is worth at that point.
Okay, see, that's what I was asking, right, okay. So as far as that category of equipment being an asset for the company, even after that max, like I said, it's a stove.
Let me paint a scenario for you.
Right.
It gets to 10 years and it's worth 8,000, right? So we've established that you can no longer depreciate it at that point, right? So it's just worth 8,000.
Right.
And then they say, well, I can't get but maybe another year out of this.
Okay.
So they use that year, just like she was saying, right? And then next year comes around, it's like, well, I can't use this anymore. I'm gonna do one or two things. I'm gonna discard it, dispose of it, or I'm gonna do what? Sell it. And when I get ready to sell it, what value do I tack on it? Market value.
But if you decide. to
And
keep
market
it,
value, if you decide to keep it, you just have useless
you will
asset
report
on
it
your hand.
as-
After the 10-year life, it needs to come off.
That's
Of
what
your
I was
books.
asking.
Period, after the 10-year life.
After 10-year life, it needs to come off of your books because in
Okay.
accounting, it no longer holds value.
Gotcha.
Now you either need to, and we're gonna talk about that in this class, discarding, disposing of assets. Yes, ma'am.
So is that like, say, a rental car, that you sell whatever kind, and then replenish it, because they, like Enterprise, they use a very rental car. And then after it reaches a certain amount of miles or years or whatever, they sell it to customers, and then they get new.
Maybe not to customers. Because from what I know of rental car companies, when their car reaches that maximum depreciation, and they can no longer do anything with it on their books, they sell it right to the auction.
Yeah.
And they get whatever market value the car is worth, and they write it off.
So so what I'm saying is, just use an example, another company would just get rid of it or whatever they do with it, and then replenish it with a new.
You don't have to necessarily replenish it. Perfect example here at the school, where we have printers, copiers, things of that nature that are no longer useful. We will give it away. We don't necessarily sell it, but it doesn't mean we replace it either. Just because one asset loses all value and is no longer useful doesn't necessarily mean you have to replace it with a new one. And we know in general businesses will replace things before they even discard other assets. So once they discard it, they just discard it. You have to necessarily say, oh, I need to replace this.
So once you sell it after, like, you sell it at 11 years, where does that money go? Does that not go onto the books?
Yeah. And the discarding of the asset, disposal of it.
So
that's a whole nother, okay.
It's a whole nother lesson. That's why I'm like, I don't know why y'all thinking this hard this week. That is a whole nother lesson for another day. However, when a company discards an asset, they will write off the asset at whatever the market value is, and they will record a gain or a loss. Because what happens if, let's just say we got ready to dispose of this or sell it at the 10-year life, and the salvage value is worth what? $8,000, and then by stroke of luck, and it could have been anything that was going on the stock market, it's really worth $8,500. So what do? We debit cash for $8,500 because we just sold it for whatever market was. So we debit cash for $8,500. We credit the asset itself, and we also credit gain on disposal. Versus if you sold it for less than market value, let's just say market value was $7,500, we still debit cash for $7,500, but we also debit loss on disposal for that $500, and we credit the asset. And I didn't want to go that far because that's chapters on down the line. Right, and I'm sorry because I tried not to go there. They took you there. I tried.
Is there a like more complex formula for like if you had a car and you bought it off the lot, you know it depreciates at different values at different years, right? Is there a value like
straight line we had, and again we're not gonna go
Am
this
I
far
getting
because this
complicated?
is something that you learn in accounting 1105, which is yes, different levels, different methods of depreciation. We have straight line depreciation. We have double decline and balance of depreciation. We have units of production depreciation. There are a lot of different methods, and depending on the type of company, the type of accounting method they use will determine what type of depreciation method they use, simply because one depreciation method might allow them to expense more on the front end versus the back end. Straight line depreciation just means this. If we say depreciation every year is $3,000, it is $3,000 every single year until salvage value has been reached.
Gotcha. Okay.
Okay? Here, this is the journal entry. So once you find out the depreciation expense, accumulated depreciation, and I want you to learn this word. I want you to look it up, even though I'm going to tell you the definition. Contra, C-O-N-T-R-A, contra asset account. Contra asset. Contra asset. So contra asset, or I should say contra account. Just say contra account, because it doesn't always have to be an asset. Contra account simply means this is accompanying account to whatever the asset is. So we know that every piece of equipment, vehicles, those types of things depreciate, right? And for every asset, they have a contra account that goes along with it, or a contra asset. So for equipment, you would see it listed equipment, and under it, you would see accumulated depreciation dash equipment. What that means is that is our way of recognizing that that asset is going to depreciate. Okay? So when you do the adjusting entry, you put the depreciation expense, you debit that, because we know all expenses will always be debited. And we always credit accumulated depreciation. Credit accumulated depreciation. And let's go on because it's a lot more to get through. Unearned revenues. I gave you the example of the concert tickets, right? Look at this. Company collected $24,000 rent in advance, debiting cash, crediting unearned rent revenue. The reason why they had to do unearned rent is because had the rent been actually earned yet? No, because they paid it in advance, right? So it says the tenant was paying 12 months rent in advance and occupancy began what date? September 1st. So that means for the first year, you only going to account for how many months? 4 months. Unearned services revenue. The company charged $100 per month to spray a house for insects. A customer paid $600 on November 1st in advance for 6 treatments. So that means the first year, how many months you going to account for? 2. November and December. And so it said at year end, the company has applied the treatments for the customer. Now, unearned rent. They collected $24,000 rent in advance, right? So the account unearned rent should have had a balance of how much? $24,000. And then what happened? How many months passed? 2. By the end of the year? 4. September, October, November, and December, right? So that's how much for each one of those months? $2,000. So that means that the account should equal, what's the ending balance? What should the ending balance be? 16,000. You still got 8 months left, right? They paid 12 months in advance. By December 31st, only 4 months had passed, right? So 12 minus 4 equals 8 months remaining. So that means we adjust for how much? How much for those 4 months? So we debit unearned rent revenue, basically taking it out of unearned rent and putting it where?
Rent revenue.
Rent revenue. Everybody sees that? Clear? Maybe. Okay. Company charges $100 a month to spray house for insects, right? They collected $600 in advance on November 1st. So that means how many months do we need to account for? 2 months. The balance of the account on November 1st was how much? 600. And then 2 months had passed, so what should it equal? 400. We do our journal entry where we take it out of unearned services revenue and put it into revenue as earned for that $200. Now, accrued, this was the one that you were confused about, right? Because we've been talking about deferred all this time. Accrued. I gave you guys an example of pay, right? I said, just because you start a job and you work for 2 weeks, do you get paid the same day you started?
No.
No, you get paid whenever the end of the pay period is, right? That is an accrued expense for the company that has to pay you. Because they know that at the end of a pay period, they have to do what? Pay you. That's accrued. That's an expense they know that no matter what they have, right? So, this example, salaries payable. At year end, salaries expense of $5,000 has been incurred, but not yet paid. So we got to do an adjusting entry to recognize the payment. Interest payable. December 31st, year end, the company holds a mortgage payable that has incurred interest of $1,000. And it hasn't been recorded and it hasn't been paid. They intend to pay it on what? January 3rd of the next year. So let's look at this example. Salary, year end, expense, $5,000 that they've been incurred. So that means the current account equals what? 0. Why is it 0?
But you said at the end of your salary expenses of 5,000.
But it's, I don't know why it's there, because it's paying.
Yes, you do.
You
Read the last sentence.
Not
Not
yet.
yet. So salaries payable
Nobody got
is
this,
But they had
0 right now.
put it
Not yet paid. So that means it started off with 0 balance. What should it equal?
5,000.
5,000, because they need to do what?
Paid.
Pay it. So here's the adjusting entry. A debit to salaries expense for that 5,000 and a credit to salaries payable, recognizing that it must be paid 5,000. And they still haven't paid it, but they're at least putting it in their payable account saying this is what we owe employees.
Okay, see, that's what I was confused, because I thought that as far as accrual should not have been accounted for immediately, shouldn't it already have been there?
Did you work all 2 weeks in one day?
No.
No, you didn't.
Okay.
So they can't accrue it until it actually has been, until it actually happens. Let's do this second one, interest payable. So with this, they had a mortgage that has incurred about $1,000 in interest, right? They intend to pay it the next year, but what should the current balance be of interest payable? 0, because they haven't paid it yet, right? But it also hasn't been recorded, which is what we're gonna do. Determine what the account should equal. What should it equal? 1,000, right? Here's our adjusting entry. A debit to interest expense for 1,000 and us acknowledging that we have a payable that must be paid of interest for 1,000.
Okay, I guess this is what confused me. I understand now that we are doing the acknowledgement, which will be interest payable. But if it has not been paid yet, why would we be putting it in expense? Because expense only goes there once we incur it, right?
We did incur it. Did we not? It tells you we incurred it.
But we didn't pay it, so what happens when we pay it?
Incur and pay are 2 different things. Incur means it doesn't happen. It must be paid. Payable is me recognizing what needs to be paid.
Okay, and then once we pay it, then we just credit the expense. Okay.
No, you don't credit the expense account. Once it's paid, what do you do? What do you do? You debit the payable account and you credit your what?
Cash.
I'm gonna get y'all there one day. It's really hard, but one day, that's my goal.
Moving along real good, and then all of a sudden
That's my
something
goal.
just goes in and it don't make sense to me.
That's my goal.
Like I'll be
Woo,
like the
Lord.
first part I was good, but that 0 to the top.
I love y'all, but I'm telling you, y'all be taking this with emotion. Okay, but I still love y'all. That don't change. It just is what it is. It ain't like you done seen this before. So it's gonna be like that for you. At least right off, right? I would imagine by take chapter 4, maybe. It might click. I always give 1 or 2 students to do that. Chapter 4. Oh, you remember what you're talking in chapter 2? I got it now. Yeah. It's okay.
Chapter 7.
And you said
Chapter 7.
7. Really? Okay. So accrual revenues, revenues earned in that period that are both unrecorded and not yet received. So here's the example we got. Accounts receivable. At year end, the company has completed services of $1,000 for a client, but the client hadn't been billed, right? Which means they clearly didn't do what? Pay. If the client wasn't billed yet, they didn't do what? They didn't pay it yet. Interest receivable. They have interest that has been earned of $500, but what happened? It's not recorded. They earned it, but it hasn't been recorded yet. So that first example, year end, they completed services for $1,000. They hadn't recorded it, so the account is going to be 0. But what it really should be is what? 1,000, which means that we have to do a journal entry by debiting accounts receivable and crediting revenue for $1,000. And sometimes you'll see this with companies. It's not that they don't want to get their money. It's just sometimes they may not have somebody in place doing the books right away, so they don't have anybody to immediately bill a client. They just keep like a little running tab of it. And that's when you'll see, this is rare, but you'll see it. Interest receivable.
I've got one question.
Yes, ma'am.
On how would I know? I know the debit and the credit. So how would I know, like, if the unadjusted is 0? Why didn't we put it over there?
Well, they told you that it hadn't been billed yet. So that means obviously that accounts receivable account has what in it? Nothing.
Right, okay.
It should have been billed, but it just wasn't. It told you that it wasn't.
Okay, the last transaction that we did, the last example, you had unadjusted 0 on the credit side.
And what kind of account was that we were dealing with? It was a payable account. This is receivable. What's the normal side of assets?
Okay, the payable is on the credit.
Correct.
Yeah, the unadjusted trial balance was 0, so we are adjusting the unadjusted trial balance. So the unadjusted trial balance is 0, so we gotta correct the unadjusted trial balance.
Well, I don't know if you gotta say that much, but all I know is this: it started off with 0. It really should be 1,000. So we gotta adjust for that. What's your name?
We had 0. And we need to
Say it again.
correct.
Say it again.
That's when we went to our general ledger, we had 0, but we knew we had performed the service. So we need to correct. Because we went to our general ledger, it would have been 0 in the beginning. But we realized we had done this work, and now we need to
Bill for it.
I have a question. Realistically, if we were to actually have those books, these accounts wouldn't be 0. We would be having to find whatever a difference is, right?
Correct. Correct. More than likely, if you're doing this in the real world, you ain't doing it by paper.
Right.
That's for sure. You find somebody that's still doing it by paper.
So my account receivable always goes up on the debit side. When you're trying to, log.
No, I don't need you to be that general. We are adjusting. And depending on how we are adjusting, it may be a debit, it may be a credit. But in this particular example, we never billed a client for services that we had already performed. And so it's no different from what you've already learned. Debit accounts receivable, credit, revenue. Interest receivable starts off with 0, right? Because it hadn't been recorded yet. But we have to adjust, and it really should equal $500, right? So that means we must do what?
Right.
Credit, debit. debit interest receivable, credit interest revenue, because they earned that, right? Links to financial statement.
Why y'all passing out these 11 o'clock class over 11:45?
All right. What's your name? Links to financial statements. So where do prepaid expenses go?
What is it?
Where do expenses go?
Balance,
What statement?
expenses go on
Income
income.
statement. So with prepaid expenses, because they've been paid upfront, right? That means that assets are obviously going to be what? Overstated. Equity is going to be overstated, because what we're saying is we received, or we paid cash for an expense, prepaid cash rather, for an expense that we hadn't actually incurred yet. So our expenses are overstated, our assets are overstated. As far as the income statement is concerned, expenses understated, equity overstated. This is going to take you some time to understand. Find it in your book and just make a little star or asterisk by it.
I understand the asset liabilities and expenses, I don't understand how the equity is affected.
Well, what does expense fall up under? Revenues and expenses fall up under what? On the accounting equation, they fall up under what? Equity. They fall up under equity. Revenue, capital, expenses, withdrawals, all that falls up under equity, right?
Okay.
Unearned revenues, liabilities, overstated, equity, understated, but revenue is going to be understated. So take some time to look over that. Now, adjusted trial balance. We did a trial balance in here last week, right?
Yeah.
And this is the same thing. You just have 2 more columns added. So this is what you did last week. These first 2 yellow columns. The adjustments that you make to things like supplies and prepaid rent, prepaid insurance, those types of things, they go in these columns. Whatever amounts you adjusted for, they go here. And then to get the adjusted trial balance, you take whatever the adjusted balance, unadjusted balance was. If there are any adjustments, subtract or add to get the new balance. Everybody sees that? So looking at this, cash was $4,275. Were there any adjustments to cash? No. So the balance is still what? $4,275. Accounts receivable started off with 0, but then we added $1,800. So now the balance of it is what? $1,800. Supplies started off with $9,720. We had an adjustment of how much? $1,050. So we subtract, because it's in the credit column and it's an asset. Subtract it from that $9,720 and we get $8,670. Prepaid insurance started off at $2,400. It expired $100, so we subtract $100 from $2,400. Now the balance is $2,300 and so forth. So you guys understand this, right? Okay.
So you said that's where we put all of this. You're actually looking at what the title is to know whether or not.
To subtract or add? Yeah, because if it's an asset account and the adjustment was on the credit side, you do what with that? Add or subtract it? Subtract it. Whereas if it was a liability and the adjustment is on the credit side, you add or subtract that? Add. Because the normal side of liability accounts is what?
Credit.
Credit.
So those adjustments are demonstrating like depreciation. Say like on the supplies.
Any adjustments
And
that you
whatever,
did.
whatever happens to be.
Whatever adjustments that you had to make at the year end, they go in those columns. Only the adjustments.
So the contract account would be listed.
It's there. Find the contra account. Where's the contra? Where's the contra asset account?
Accumulated depreciation.
There it is, accumulated depreciation up under equipment, because I always
okay.
told you the asset will be listed first, and then the contra asset account,
Okay.
okay? Prepare financial statement. Now, we went over this long ago, but what items are on your income statement only?
Expenses and income.
Expenses and revenues. What accounts are on your balance sheet? Assets, liabilities, and equity accounts. What is on your statement of owner's equity? Capital withdrawals, net income or loss, right? And what about cash flows? Cash inflows and outflows, right? So this is saying step one, and these statements are prepared in this order. They never change. You always do an income statement first, then you do a statement of owner's equity, then you do the balance sheet, and then you do the cash flow statement, because something comes from each of those statements to help you prepare the next one. So, income statement, you do revenues and expenses to find out what? Net income or net loss. You take that net income or net loss and it goes on the statement of owner's equity. You get the ending capital balance and that goes where? On your balance sheet. And on your balance sheet, your cash account goes where? Statement of cash flows. So this is why it's telling you this is the way that you need to do it. Need to know. Use the following trial balance to prepare an income statement, a statement of owner's equity, a balance sheet unclassified, and it's giving you the balance of the capital account at December 31st is $75,000. Now, I'm not going to go through this with you because I want to do a different problem with you. We didn't go through this statement because it's long, very long.
So it's not on the homework?
It'll probably be on the homework, yes.
So I don't have to do it.
It's not
Since we didn't go up.
You said you what?
Well, I don't have to do that part since we didn't go up.
The last you tell? Yes, you do.
Okay.